Hello and welcome to this week's Market Focus on the 31st of October. Well, it's Halloween today, and the Japanese certainly didn't disappoint us. Early hours of this morning, the Japanese authorities have decided to intervene unilaterally in the FX markets as to weaken their own currency ahead of this week's G20 summit. The result has been a 4.2 drop in the yen since this morning to 78.92 in its cross versus the US dollar. So before this morning's action, the yen had been trading at close to a post-World War II record high near 75 yen to the dollar. So a pretty scary start to the morning for those of you who are in the FX markets, especially in any of the yen pairings. So hopefully none of you got caught up in that, but these are the things, unfortunately, that overnight that can certainly appear. And certainly these are the types of things that you need to really be aware of when trading these markets. But going back to the week that was, and it certainly has been an interesting week, and I'm sure most of you must have read the headlines. And as far as the main part of the news was a Eurozone deal boost that had been really lingering over the past few months over these markets. And markets across Europe have certainly smoothed over the last few days. And the leaders in Europe have now produced a plan to stabilise the region. And last Thursday was a tailing point. The outline to recapitalise the banks by nearly 100 billion, should I say, euros, to reduce the Greek debt burden by a 50% with a haircut on Greek bonds, and to leverage the European Financial Stability Facility, which is known as the EFSF, to over 1 trillion euros. Some of the details have yet to be hammered out, and the leveraging of the EFSF will be carried out in November with the establishment of special purpose investment vehicles, better known as the SPIV, backed by the emerging market investors. So there's a lot more details needing to come out of the fine print, nowhere near out of the woods. They've got something on the table. The details really need to be put through, and the question is whether will it be enough in the long term, or whether it had merely put off the day of reckoning for a little while longer. While we have those numbers to go on, it will be rather pointless if the leaders don't find a way to stimulate growth, and we still have the question of Italy's finances. So that's really what's been happening. And I mean, since then, as we've seen, the market really has been going great guns. We'll push on to really this week's economic outlook. It's going to be another pretty being the start of the month, it's going to be quite a heavy week on the data front. U.S. employment figures and their revelations about the state of the U.S. economy obviously will return to the forefront of traders for this week. It will possibly take over to what people were looking at in Europe. So it's going to be more significant to the markets now that the European stories have taken a back seat. So economists expect this Friday's release of the non-farm payrolls to show a creation of 95,000 jobs outside the agricultural industry in October. So again, we all shout about this figure, and it certainly is the biggest figure of any trading month. And with 120,000 private sector jobs created and 25,000 public sector jobs lost, the overall unemployment rate is expected to remain at 9.1%. So that's out on Friday. And dealers will have plenty to keep them occupied before the employment report, which is likely to define sentiment at the end of the busy week. The Federal Reserve's policy announcement, which is due out on Wednesday, is unlikely to contain any surprises, with both interest rates and the count of the US central bank stimulus measures left unchanged. But fresh economic projections issued on a quarterly basis are due out this week. Will offer guidance to the next step of what the Fed opens and just to see what they're looking for to protect its growth. Ben Bernanke, the Fed chairman, will appear in the press conference later on Wednesday. So Wednesday night's going to be an interesting period for the markets. They'll be facing questions and thinking on additional stimulus measures and any other really significant changes which they're looking to really start pumping up and propping up this US economy. And to really finish things off in the US side of things, the CPI, the Chicago's Purchasing Managers Index, is due out today and is expected to show stronger demand for heavy equipment and improved activity in the construction and energy sectors in the US industrial heartland. So, that's a bit of data out today. Obviously, the main one we're looking at is on Friday. Across the pond over to Europe, in UK, Tuesday's first reading of the third quarter GDP data are expected to see a modest rebound with a growth of 0.7% from the previous quarter on a year-on-year basis. And the manufacturing purchases index, which is out on Tuesday, is expected to slip to 50.3 for October from September's 51.1, with the fulfillment of backlogged orders that lifted today to the data. So, this is the week ahead, and obviously you don't need to be a rocket scientist to work out Friday is going to be the big and key data and the last hurrah, and see how we really finish this thing off. We've had an absolutely unbelievable few days rally, and the sessions really have been putting in new highs across all the main indices. And whether we draw a pause for breath this morning maybe for it to go up, but all the weekly charts are now have really started to look a very bullish tone onto them. So with the fundamentals, certainly keep an eye out on Friday, ladies and gentlemen, and I'll be bringing you back next week's forecast again on Monday. Thank you very much. Bye-bye.